Welcome to NACD BoardVision, where leading boardroom advisors, governance professionals, and seasoned directors discuss critical issues related to your responsibilities in the boardroom.
I'm Christopher Clark, publisher of NACD Directorship magazine. This is BoardVision, and I have the pleasure of speaking with Ken King of Skadden today on the wonderful subject of M&A. Ken, welcome aboard. What are the issues, and certainly what are the core questions that a board should ask when management comes to them and proposes a spin-off of a business?
I think in terms of the board's first questions, they're the natural ones that would come to any board member, which is what's the rationale for it, what's the financial backing for it, by doing a divestiture or a spin-off, is that really going to enhance shareholder value, either because the businesses are very different and the multiples applied against each business may be different. Issues that will inevitably come to the board include the equity compensation arrangements for employees that either go with the business, stay with the business that isn't being spun off. How does the equity get split off or split up and adjusted? And there's a variety of ways in which
is that the critical element or a critical element?
That's a critical element where I would say management's interests may be different and just structurally interested in enhancing their own compensation, as any person would. But there's various ways to do it, and so it's one of those areas that I think boards have to look at with a critical eye to understand what's in the best interest of all shareholders and enhancing shareholder value.
From the perspective of an acquired company, how can you protect yourself as a board member, inoculate yourself against, quote unquote, the tainted CEO?
One of the hallmarks of what Delaware courts look to in looking at the process that a board has gone through in a determination to sell itself or to engage, or actually not engage in a significant transaction is really, they look for independent directors to be in control of the situation, to drive the situation. And I think that almost more important than anything else is what can lead to a good or a bad process. And oftentimes when there is a potential acquisition that structurally inevitably leads to potential conflicts, we will often do things like have written rules of the road for the CEO and management team as they start to engage in a process.
When you give them those rules of the road,
right,
you and Skadden and your team, and I'm going to make an assumption here, or I'm going to ask, is that you work with small, medium, and large companies. Mm-hmm. Are there less surprises with the larger company directors? You know, less questions, less rules you have to go through? Is there a relationship between the size of the company and the level of their sophistication?
I wouldn't say that necessarily. I mean, certainly there's a there's a relationship perhaps between size of company and sophistication, but not necessarily in this area. It is the case that while directors may have gone through one or two or even several transactions where they sit on the board of a company that is being acquired, it's still a relatively small universe of experience to draw upon compared to the bankers and lawyers and others who do this for a living.
Ken, the role of the activist has evolved, I think, in the last couple of months at lightning speed. And I'd like to ask your opinion, in terms of driving acquisitions, in terms of their role in target companies. What is your view? Is mine an outlier view or not?
Success begets success, and event-driven funds and so-called activists have earned outsized returns, and therefore more money is flowing into their funds, and that fuels more of this activity. I think fundamentally institutional investors are happy to see it. Some of them, I think, are proactively identifying companies that they believe could use a good wake-up call and activity from activists. But I think fundamentally activists are looking for situations where stock is undervalued. They think that they have an investment thesis that suggests that by doing certain things that over the medium term, and I wouldn't say necessarily a few months, but over a medium term kind of a period, that value can be unlocked.
Ken, regarding Delaware law, can you shed some light, for me and to our audience on two-step deals?
Yes, they became far more easy to do in the aftermath of an amendment to Delaware law that became effective in August of this year that allows you to do a tender offer followed by a back-end merger at the same price if you get 50% plus one tendered in the tender offer to begin with. It used to be that in order to do a so-called short-form merger and immediately close the back end after a tender offer, you had to get to 90%. So effectively, that threshold has been moved down to 50% plus one, which is beneficial to deal makers and to companies, both buying and selling companies, because the tender offer process is generally considered quicker.
Beneficial to deal makers and hopefully their shareholders.
And their shareholders, because it's a quicker process. Once you've agreed to a deal, you can get to the actual closing and 100% ownership within, say, a month and a half of signing up a deal, rather than the 2.5 to 3.5 months that a one-step merger process would typically take.
On behalf of NACD, Ken King, and Skadden, thank you. This is BoardVision.